Reading mutual holding companies, I had to take a call somewhere in subsection G, which was about conversion or liquidation of mutual holding companies. And I was all the way up to 19 within that section about liquidation accounts. I was reading about sub-accounts and adjusting sub-accounts. I'll just pick up there. A stock holding company must reduce the balance in the sub-account if the deposit account in the account holder's savings account on any annual closing date at the fiscal year end is less than what it was last year. And I do remember that the bank isn't responsible for adjusting it at every day's close end. And I think the last part under that section is if a liquidation occurs, the holding company must provide each sub-account holder with a distribution in the amount of the account balance. Liquidation. A liquidation is a sale of the assets and the settlement of the liabilities of the holding company with the intent to cease operations. 2. Upon liquidation, the stock holding company must return the charter to the federal agency that issued it for cancellation. That doesn't include mergers and acquisitions. In the case of mergers and acquisitions, the surviving company holds the charter. Number 20, post-conversion stock plans. Within 12 months following conversion, the stock holding company may implement a stock option plan, or ESOP, or other tax-qualified employee stock benefit plan, or a management recognition plan, provided it meets these requirements. A, the stock holding company discloses the plans in the proxy statement and offering circular. No shareholder vote is required to implement the ESOP, and the ESOP is tax qualified. B, the option plan does not exceed more than 10% of the number of shares that were issued in the conversion. The ESOP and MRP cannot hold more than 10% of the shares issued in the conversion plan. However, if the stock holding plan is has tangible capital of 10% or more, the ESOP and MRP may have up to 12% of the shares issued with FRB approval. C, the MRP may hold not more than 3% of the number of shares issued in a conversion, but may hold up to 4% if the resulting stock holding company has tangible capital of 10% or more after the conversion of the FRP is approved. And the FRB approves, if it's different. D, no individual receives more than 25% of the shares under any plan. E, the directors who are not officers do not receive more than 5% of the shares of the MRP or option plan individually, or 30% of any plan in the aggregate. F, the shareholders approve each of the option plan and the MRP by a majority of the total votes eligible to be cast prior to the implementation of the plan. The meeting to have this vote must be at least 6 months after the conversion date. G, any proxies issued on such plans state that the plan complies with FRB regulations and the FRB does not endorse or approve the plan. H, the stock holding company does not grant stock option at less than the market price at the time of the grant. I, the stock holding company does not fund the option plan or the MRP at the time of the conversion. J, the plan does not begin to vest earlier than 1 year after shareholders approve it, and it does not vest at a rate greater than 20% per year. K, the plan permits accelerated vesting only for disability or death or in case of a change of control. L, the plan provides that executive officers or directors must exercise or forfeit their option in the event an institution becomes critically undercapitalized under applicable capital regulations, is subject to the FRB enforcement action, or receives a capital directive. M, the stock hold company files a copy of the option plan or MRP with the FRB no later than 5 days after approval, certifying that it is approved by the shareholders. And the stock holding company may provide dividends, equivalent rights, or dividend adjustment rights to allow for stock splits or other adjustments to the plans. O, plans implemented more than 12 months after conversion are not subject to these restrictions as long as materials pertaining to its shareholder vote on any plan are not distributed within 12 months after conversion. Number 21, under liquidation and conversion plans, restrictions on the sale of conversion rights by directors, officers, and their associates. Directors and officers who purchase shares may not sell them for 1 year after the date of purchase except in the case of death of the purchaser. B, the stockholding company must include a notice of the restriction on each applicable certificate. C, the stockholding company must instruct the stock transfer agent of any transfer restriction. D, for 3 years after the conversion, the officers, directors, or their associates may purchase stock of the holding company only from a broker or dealer registered with SEC unless it involves a negotiated transaction of more than 1% of the outstanding stock. E, officers and directors may purchase stock through any of the management or employee stock benefit plans. Number 22, repurchase of conversion shares. The stockholding company may not repurchase a share in the first year after conversion except in extraordinary circumstances. The company may make open market repurchases of up to 5% of the outstanding stock if the company files a notice and the FRB does not disapprove. The stockholding company may repurchase qualifying shares of a director or conduct a FRB approved repurchase pursuant to a offer made to all shareholders. Repurchases to fund MRPs that have been ratified by shareholders do not count toward the repurchase limitations, but if they are made during the first year after conversion, FRB approval is required. 4, purchases to fund tax-qualified plans do not count toward the restriction. 5, after the first year, repurchases are not restricted. B, under repurchase of conversion shares. All stock repurchases are subject to the following. Roman numeral 1, the stockholding company may not purchase shares if such purchase would reduce the capital below the amount required for the liquidation account. 2, must comply with applicable capital distribution requirements. And 3, the restrictions on share repurchases apply to charitable organizations which are to be aggregated with holding company purchases. Letter C. The FRB must approve all repurchases made during the first year following conversion after notice is filed with the FRB describing the proposed repurchase program. If the FRB disapproves, the holding company may not purchase the shares. And D, the FRB will not disapprove a purchase if 1 through 4, 1, the repurchase program will not adversely affect the company financial condition. 2, the company submits sufficient information to evaluate the repurchase. 3, the company demonstrates extraordinary circumstances and a compelling and valid business purpose. And 4, the repurchase program would not be contrary to other applicable regulation. Number 23, under liquidation and conversion of mutual holding companies. Stockholding company, 23 is declaring and paying dividends following conversion. A, stockholding companies may declare dividends on shares after the conversion if the dividend will not reduce the regulatory capital below the amount required for the liquidation account. 2, the company complies with all capital distribution requirements. 3, the company complies with all 4, the company does not return any capital other than ordinary dividends to purchasers during the term of the business plan submitted with the conversion application. Beautiful. Acquiring shares after conversion. Number 24, under liquidation and conversion plans. For 3 years after the conversion, no person may, directly or indirectly, acquire or offer to acquire the beneficial ownership of more than 10% of any class of stock without written FRB approval. B, this restriction does not apply to any offer made with a view toward public resale of the stock. And C, unless the FRB objects in writing, any person may obtain up to 1% of any class of shares D, a corporation whose ownership is the same as the stock company's ownership may acquire more than 10% of the stock if it makes the offer more than 1 year after conversion. E, one or more tax-qualified ESOP plans may acquire shares if the plans do not beneficially own more than 25% or any class of stock. F, the FRB may deny any application to purchase stock if it is contrary to the purposes of the conversion regulations. B, is manipulative or deceptive, and C, subverts the fairness of the conversion. Page 700. 4, is likely to injure the holding company. 5, is inconsistent with the plan to meet credit and lending needs of the proposed market area. 6, otherwise violates the law. And 7, does not prudently deploy the conversion proceeds. G, additional requirements after conversion. I, the company must promptly register the shares under the Securities Exchange Act. 2, the shares may not be deregistered for 3 years. 3, the company must encourage and enlist a market maker to make a market in the shares. 4, the company must use its best efforts to list the shares on a national or regional exchange. 5, the company must file all post-conversion reports the FRB requires. Number 25, contributions to charitable organizations. A mutual holding company may form a charitable organization as a part of a conversion to stock form. B, some of the conversion shares may be contributed if, Roman numeral 1, the plan of conversion provides for the contribution and members approve it. 3, the IRS approved it or approves it within 2 years after the formation as a tax-exempt charitable organization. C, at the meeting to consider the conversion, the members must separately approve by a majority vote a contribution of conversion shares or proceeds to the charitable organization. D, a reasonable amount of conversion shares or proceeds may be contributed to a charitable organization if it will not exceed limits for deduction under the IRS code, and the FRB does not object on supervisory grounds if the mutual holding company is well capitalized. The FRB generally will not object if it contributes an aggregate of 8% or less of the conversion shares or proceeds. And E, the charitable organization's charter must have a primary purpose to serve and make grants in the community. F, the charitable organization's charter must provide that as long as the organization controls shares, it must vote them in the same ratio as all other shares voted on each proposal. G, for at least 5 years after its organization, 1 seat on the charitable organization's board is reserved for an independent director from the local community, and 1 seat is reserved for a director from the board of the holding company or the acquirer in the event of a merger or acquisition of the organization. H, the FRB may examine the charitable organization at the charitable organization's own expense. I, the charitable organization, must comply with all of the FRB supervisory directives. J, the charitable organization must annually provide the FRB with a copy of its annual report submitted to the IRS. Letter K, the charitable organization must operate according to written policies adopted by its board of directors, including a conflict of interest policy. L, the charitable organization may not engage in self-dealing and must comply with all laws necessary to maintain its tax-exempt status. Number 26, conflicts of interest. A director, officer, or employer who has the power to direct the management or policies of the mutual holding company or the resulting stock holding company and serves as a director of the charitable organization is subject to the following restrictions. Roman numeral 1, the person may not advance their own personal or business interests or those of others with whom the person has a personal or business relationship at the expense of either the mutual holding company or the resulting stock company. 2, if the person has interest in the matter or transaction before the board of directors, the individual must disclose all material, non-privileged information relevant to the board's decision on the matter or transaction. 4, refrain from participating in the board's discussion of the matter or transaction. And 5, recuse him or himself from voting on the matter or transaction. Letter B under conflicts of interest. The board of the mutual holding company must identify the directors that will serve on the charitable organization's board before adopting a plan of conversion. These directors may not participate in discussions concerning contributions to the charitable organization and may not vote on the matter. C. The stock certificates of shares to the charitable organization must include a legend. The board of directors must consider the shares that this stock certificate represents as voted in the same ratio as all other shares voted on each proposal considered by the shareholders, as long as the shares are controlled by the charitable organization. D. As long as the charitable organization controls shares, the resulting stock holding company must consider those shares as voted in the same ratio as all shares voted on each proposal. E. After the stock offering is complete, the resulting stock holding company must submit an executed copy of the following documents to the appropriate reserve bank: the organization's charter and bylaws, conflict of interest policy, and gift instrument for the contributions of either stock or cash. Number 27, voluntary supervisory conversions. A. The holding company must comply with this section to engage in a voluntary supervisory conversion. B. In conducting a voluntary supervisory conversion, the mutual holding company may sell its shares to the public, convert into stock form by merging into a state charter corp, or sell its shares directly to an acquirer, an individual, company, depository institution, or holding company. Members of the mutual holding company do not have the right to approve or participate in a voluntary supervisory conversion and will not have any legal or beneficial ownership interest in the converted association unless the FRB provides otherwise, other than a liquidation account. D. A mutual holding company may be eligible to engage in a voluntary supervisory conversion if I. Either the mutual holding company or its subsidiary association is significantly undercapitalized or is undercapitalized and a standard conversion would not make it adequately capitalized. Undercapitalized will be a viable entity following conversion. So a mutual holding company may be eligible to engage in a voluntary supervisory conversion if either the mutual holding company or its subsidiary association is significantly undercapitalized and will be a viable entity following conversion, and severe financial conditions threaten the stability of the mutual holding company, and a conversion is likely to improve its financial condition. Right, so like as opposed to a bankruptcy, I guess. There's a lot of errors in this text, so it makes it kind of confusing. Sort of making it up as I go when the errors are changing the meaning of the text here. Letter E, the mutual holding company or its subsidiary will be a viable entity following the conversion if it satisfies the following. Numeral 1, 2, and 3. 1, it will be adequately capitalized as a result of the conversion. The holding company and its acquirers comply with the applicable supervisory policies. The transaction is in the best interest of and will not be detrimental to the holding company, its subsidiary savings association, or the deposit insurance fund, or public interest. F, the majority of the board of the mutual holding company must approve a plan of voluntary supervisory conversion. G, the plan of voluntary supervisory conversion must include the name and address of the mutual holding company, the name, address, date, and place of birth, and social security number, tax ID number of each proposed purchaser of shares, and a description of their relationship to the mutual holding company. 3, the title, per unit par value, number and per unit in aggregate offering price that the mutual holding company will issue for the number and percentage of shares that each investor will purchase. 5, the aggregate number and percentage of shares that each director, officer, and any affiliates will purchase. 6, the description of any liquidation account. 7, certified copies of all resolutions of the board relating to the conversion. H, application. The mutual holding company must include the following documents in the application to the Fed. Evidence establishing that the mutual holding company meets all eligibility requirements, an opinion of qualified independent counsel or CPA that the conversion represents a tax-free reorganization. 3, a plan of conversion. 4, a business plan. 5, the most recent audited financial statements. And Thrift Financial Report, TFR, doesn't exist anymore. Now it's the call report. Numeral 6, a description of estimated conversion expense. 7, evidence supporting the value of any non-cash asset contributions. Numeral 8, pro forma financials that reflect the effects of the transaction. 9, proposed charter and bylaws. 10, any agreements between the mutual holding company and proposed purchasers. 11, a copy of any existing and proposed employment contracts. 12, all filings required under the securities offering rules. 13, any required filings under the Holding Company Act or Control Act. 14, any subordinated debt agreements. 15, applications for permission to organize a stock savings and loan holding company for approval of a merger. Number 28, FRB review of the application for voluntary supervisory conversion, which is hilarious because they're the only ones that are conducting the voluntary supervisory conversion. So the fact that they have to review it is really irritating. Okay, maybe they're not conducting the voluntary supervisory conversion, but my guess is that they are. So now we get to read a whole other section about the review of their own application. The FRB will generally approve the application unless it determines that the holding company does not meet the eligibility requirements, the transaction is detrimental to or would cause potential injury to the mutual holding company, its subsidiary savings association, or the deposit insurance fund, or contrary to the public interest. 3, the mutual holding company or its acquirer or the officers or directors of either have engaged in unsafe or unsound practices in connection with the conversion. 4, the mutual holding company fails to justify an employment contract incidental to the conversion, or it will be an unsafe or unsound practice or represent a sale of control. B, mandatory approval condition. 1 through 4. 1, the conversion stock sale must be complete within 3 months after the application approval. 2, the mutual holding company and the stock holding company must comply with all filing requirements. 3, the mutual holding company must submit an opinion of independent legal counsel indicating that the sale of the shares complies with the applicable securities requirements. 4, the mutual holding company and resulting stock holding company must satisfy any other requirements or conditions the FRB may impose. And C, under FRB review of the application for voluntary supervisory conversion, discretionary approval conditions. So the other 4 were mandatory approval condition. Now we're talking discretionary approval condition. The mutual holding company and resulting stock holding company must satisfy any conditions and restrictions the FRB imposes to prevent unsafe or unsound practices, to protect the DIF, and to prevent potential injury or detriment to the mutual holding company before or after the conversion. Numeral 2, the mutual holding company or resulting stock holding company must infuse more capital if necessary for safety and soundness reasons. And I'm not going to go into indemnification at this time. This is subpart H. I'm going to take a break here because I'm getting pretty darn near close to 25 minutes. After subpart H, indemnification, you have employment contracts, subpart I, and that should actually bring us to the end of the section.